Welcome back. We're going to continue our series on financial analysis on NASCON Allied Industries Plc. So, we've done the financial ratios of performance ratio, we've done for profitability, we've done for efficiency. We are on the financial leverage ratio, so we've also done for liquidity ratio. And we're going to be finalizing this series on solvency ratio. Like we normally do, we'll calculate the ratios first, then we go ahead and do the interpretation at the later end of the video. So the first one we have is the interest coverage ratio or the interest cover ratio. I'm going to go to my CFI material here. So I have solvency ratio basically. So it says the interest coverage ratio tells us whether the company will be able to recover what is owed in interest to its creditors. So the formula is basically EBITDA or EBIT over interest expenses. Like I said, when we get to the later aspect of the video, I'm going to be interpreting what we are going to be calculating. So I'm just going to move ahead to my Excel sheets under this section here. And so what I'm going to do, because I need the heading of this, because I need the heading so I can be able to trace what I'm doing in the year 2021 down to 2025. I'm going to introduce a free spin here. So I'm just going to do Shift and the space bar. So I will do Alt WFF, which is the shortcut, and I have my years there. So I'm just going to go back to my interest coverage ratio. So I have equals to the EBIT or the EBITDA. So I'm going to check which one do we have. Remember I said your EBIT is the same thing as your operating profit. So I'm just going to go with EBIT divided by your interest expenses. So where do we have our interest expense? Our interest expense is the same thing as our finance cost. So I'm just going to make this. I've selected this, but I'm going to make it absolute because our finance cost here is in subtraction. It is an outflow. I'm just going to come here. Is it I have ABS to make it absolute? I just have minus sign. So minus times minus is going to give us plus. So I have enter. And after 3.16, then copy down to the right using Control R, and we are good to go. The remaining ratios are pretty straightforward because the formulas or their formula is basically the names of the ratio. The first one we have is debt to equity ratio. So that's just, we are going to express debt in relation to equity. So I'm just going to come here, equals to add debt. If you look at your balance sheet, you know you don't have debts there. You just have your assets, which is divided into your fixed assets or your non-current assets, and your current assets. You have a equities and liabilities section, which is regarded as your equity and your liabilities. So I'm going to take our debt as your long-term liability, which is also called your non-current liabilities. I'm going to take that. Or if you can classify our debts to those are interest-bearing liabilities, so I'm just going to do that and just divide it by equity. So I'm just going to take non-current liabilities, which is this divided by my equity. So just go down to the section of your equity rather. So I have equity here, and I'm going to select enter. So I have 0.39. Let's copy this to the right. Then the next one is to your total assets. So I'm just going to go back to my financials. My non-current liability is my debt divided by total assets. Yeah, total assets. Then I have this here. So we have this. I'm just going to do just copy this down to the right, and we're good to go. So the next form ratio says your total liability in relation to your equity. So I'm just going to go down to my financials. Now we are not selecting non-current liability. We are selecting the addition of non-current liability and current liability, which is going to give us total liability. So I'm just going to select my total liability divided by in relation to equity. So I'm just going to go down to the equity section and select equity. Then I have enter. So I'm just going to copy this down to the right also. Then I have the last one. Your total liabilities in relation to your total assets. Go down back to your financials, your total liability selected divided by your total assets. We're going to have this divided by our total assets, and we are good to this. So I'm just going to copy this down to the right. And we have our solvency ratio calculated down from your interest coverage ratio down to your total liabilities in relation to your total assets. Now we'll move on to the interpretation of these ratios. Moving on to the interpretation of this ratio. So the first one we have is the interest coverage ratio. This is basically saying how many times can our earnings before interest and tax can it cover our finance costs, our interest expenses, the amount of money that was borrowed from outsiders, how many times can we repay back the interest? So we have here 3.16 times. This is good. Like we can actually pay back our creditors, our borrowings, we can pay them 33 times without it affecting us. And then we have for 2025, which is showing 65 times. Absolute perfect. We move on to the next ratio, which is a debt to equity ratio. Your debt to equity ratio, I'm going to tie it down to your total liability to equity ratio because same interpretation basically. It's just that the formula one considers non-current liabilities, which is long-term liability, while the other considers the total liabilities, which is the non-current liability in addition to the current liabilities. So what is this formula saying? It says if you look at the capital structure of a company, the way a company is financed, there are two ways a company is financed, which is the debt and the equity. So you are trying to look at the relationship of your debt to equity. Which one is higher among the two? If it is less than 1, as we have it here, 0.3 down to 0.11, it shows that more of equity is used to finance the company, which is kind of a good thing here because we don't really have, we're not going to be having an issue with debtors, with creditors when they are trying to get back their loans and interest and stuff like that. So it is a good thing when the ratios are low for debt to equity ratio. Again, it shows how many percentage of your debts in relation to your equity is used to finance the business generally. Same thing applies to your total liabilities to equity. Now you're looking at not just your current liability now, you're also looking at your current liability, those short times liability, which is your current liability. Now your debt to total assets, basically where your debt to total assets look as is what proportion of your creditors amounts or creditors money is used to finance your total assets. Remember, we said your assets are those company resources that are used to generate non-revenue. Yes, they are belongings of the business. So how many percentage of debt do we use to actually finance the resources that are owned by the business? Yeah, so same thing applies here. Your debt to your total liability and your total liability to your total assets. Yeah. So a lower ratio also signifies that the company is doing well. Yeah. So there's financial stability in the company. So when you have a higher ratio, so there's leverage risk and there's insolvency risk basically attached to the organization. So overall, I would say NASCON is actually doing well in relation to its solvency ratio and overall in relation to the performance ratio that we've seen from the beginning of this video, from the series when we started. Yeah. So we have the profitability ratio, they are performing well in terms of profitability ratio. We have the efficiency ratio, they are also doing well. This is for trend analysis. Remember, I said we have various analysis that we can do. When we do for industry analysis, comparing NASCON to other companies that actually operates in the same industry, now we can actually, that's benchmarking, we can actually do more analysis on that. But for this, which is the trend analysis, you are looking at the performance over a series of period of time. So even with this, we can see that NASCON Allied Industries Plc is actually doing great. Yeah, especially in terms of their solvency ratio. Now you can look at the performance of this ratio and make decisions, financial decisions overall. Thank you. Meet in the next video.